You're watching vTalkInsight, Market Drivers Daily for December 29th, 2025. After one of the strongest AI and liquidity-driven rallies in years, markets head into year-end with stretched valuations, powerful growth tailwinds, and a Federal Reserve at a possible turning point. Today we focus on three forces shaping portfolios now: the AI concentration story, signs of genuine growth acceleration, and what an uncertain easing cycle could mean across assets. AI has moved from a niche growth theme to the core driver of both macro narratives and market pricing. Earlier this week, we highlighted how AI had shifted beyond a momentum trade into the main engine of CAPEX and productivity stories, and that framing still holds. The twist today is that market risk is increasingly concentrated in AI-related equities and credit, so the durability of the AI narrative into 2026 is becoming a central question for multi-asset portfolios. The tech-led rally remains anchored in a small group of hardware and platform winners. NVIDIA's acquisition and licensing deals around Grok's technology aim to strengthen its dominance in AI inference, while demand for its current Blackwell generation chips is so strong that cloud GPU inventory is effectively sold out. Micron has rallied about 230% this year and is set to open at record highs on sustained demand for memory chips in AI servers, underscoring how critical AI infrastructure has become to overall equity leadership. On the software and model side, AI-native firms are scaling at unprecedented speed. One example is a leading AI platform reaching roughly 800 million users and 1 million business clients in only 3 years, showing that adoption and monetization can move extremely quickly when the product fits. The broader market expects consolidation around a few dominant players, with OpenAI, Google, and Anthropic viewed as current leaders, and Alphabet seen as a structural winner thanks to its research base, talent, and infrastructure. AI is now reshaping the real economy and labor markets in visible ways. Automation is driving workforce reductions in sectors like insurance, where firms such as Chubb plan to cut up to 20% of staff over 3 years. Some companies appear to be using AI as a pretext for layoffs, rehiring former employees at lower wages. While the rapid integration of AI tools reduces demand for traditional coding roles and pushes universities to encourage reskilling toward more advanced AI complementary skills. Beyond pure tech, AI adoption is spreading across retail, healthcare, and energy. Retailers are leaning into omni-channel models, using AI-driven search, personalization, chatbots, and process automation to reach consumers and protect margins, especially as shoppers prioritize value. In healthcare, pharma services that leverage generative AI for drug development are seen as promising growth areas, while in energy, advances in AI and extraction technology have lowered U.S. oil production costs and enabled high output even in a weaker price environment. The AI data center build-out is running into hard physical constraints. Rising electricity demand from AI facilities is driving up local power prices and creating political pressure, particularly in states such as Texas and Virginia, where renewable build-outs lag the pace of demand. Persistent power and water bottlenecks in Texas are emerging as key hurdles for further expansion, and global AI data centers are projected to push annual water usage into the 1.1 to 1.7 trillion gallon range, raising ESG and regulatory risks that could slow the infrastructure cycle. All of this is happening against a valuation backdrop that is already stretched. AI infrastructure investment is accelerating at an unprecedented pace, and while there are pockets of frothiness, there is not yet a clear consensus that a full-blown bubble has formed. However, investors are becoming more skeptical of AI-driven equity gains, pointing to selective winners and mixed results at names like Oracle, heavy CAPEX burdens at hyperscalers, and concerns that some firms and even investors such as SoftBank are selling high-performing assets to fund still unproven AI revenue streams. Looking ahead, the same AI trend is both a growth engine and the main concentration risk for markets. if AI-driven productivity and profits show up clearly in upcoming earnings. The tech-led rally and related credit markets could remain supported even at high multiples. If that evidence disappoints, the combination of concentrated leadership, heavy IPO issuance from names like OpenAI, Anthropic, SpaceX, Stripe, and Databricks, and resource constraints around power and water could turn AI from a tailwind into a source of volatility. How this balance evolves will shape not just tech valuations, but the broader growth narrative we turn in next. The growth backdrop remains tilted toward upside, and it is no longer just about AI leaders. Earlier summaries highlighted how strong U.S. data and resilient consumers were driving a mild reacceleration, and new information reinforces that view. Multiple tailwinds are expected to support stronger U.S. growth into 2026, including fiscal stimulus, lower oil prices, a weaker dollar, and easing trade tensions, all of which help both households and corporates. Recent consumer data around the holiday period point to surprising strength. U.S. holiday retail sales are expected to grow around 4 to 5% year-on-year, with specialty retail traffic up more than 6% and sales close to 5% despite affordability concerns and tariff noise. Gift cards have become a dominant choice, partly because of a compressed shopping window, which likely pushes additional spending into the post-holiday period and extends the consumption impulse. Consumers are clearly focused on value, but they are still spending. Off-price retailers, dollar stores, and large platforms such as Walmart and Amazon are benefiting as shoppers trade down but keep volumes high. Retailers that deploy dynamic pricing and AI-driven tools to manage inventory and personalize offers appear better able to defend margins, showing how technology and value positioning can work together in a slower but still resilient demand environment. On the corporate side, balance sheets in the U.S. remain robust, with companies increasing cash reserves for both investment and precaution, which supports optimism about economic resilience into 2026. Capital spending is expected to broaden beyond the current AI leaders next year, helped by easier financial conditions and several sources of fiscal stimulus, while ongoing investment in AI, robotics, and productivity tools is seen as a way to support profit margins across a wider range of sectors. Healthcare is emerging as a major growth engine in its own right. The pharmaceutical sector has outperformed the broader S&P 500 this quarter, rising about 18.5% versus roughly 3.5%, reflecting enthusiasm for innovation and revenue growth potential. Weight loss drugs such as GLP-1 treatments are driving spillover demand in apparel, footwear, and accessories as consumers change sizes, and oral obesity drugs are expected to push adoption from current single-digit levels into double-digit territory, supporting both healthcare revenues and recurring retail purchases. Other growth pockets are appearing in less traditional areas. Domestic box office revenues are projected to approach $9 billion this year, still below pre-pandemic levels, but helped by a strong holiday slate, and theatrical releases in 2024 are expected to deliver the strongest year since the pandemic. The U.S. National Space Policy signals a long-term commitment to lunar infrastructure and nuclear propulsion, while companies like SpaceX, Blue Origin, and Rocket Lab are lowering launch costs and increasing frequency, supported by rising international space spending and intensifying competition. Strategists expect this growth mix to translate into earnings rather than just multiple expansion. Earnings growth of roughly 15% year-on-year is anticipated to be the main driver of equity gains, with forecasts for double-digit S&P 500 returns built on both continued strength in AI-related elite stocks and a broadening rally into healthcare, banks, and industrials. If the economy avoids recession and the Fed delivers at least some rate cuts, leadership is expected to extend to cyclical sectors and to small and mid-cap equities, especially where increased merger and acquisition activity can unlock value. The key risk is that much of this good news may already be reflected in elevated valuations, which leaves less cushion if growth or earnings underdeliver, setting the stage for policy to play an outsized role. Monetary policy expectations are now the main hinge for cross-asset pricing, but the path ahead looks less straightforward than the recent equity rally implies. Markets have already surged on the idea of Fed easing, yet much of that is likely priced, so the debate has shifted to how many cuts actually materialize, how fast, and what a changing Fed leadership might mean for the broader easing and liquidity framework. Current pricing generally reflects expectations for 1 to 2 rate cuts, and many participants see the Fed as closer to a neutral stance than widely assumed. Some expect the Fed to deliver only 1 cut in 2026, arguing that stronger GDP growth and robust earnings reduce the need for aggressive easing, and that a scenario with 3 or 4 cuts would likely signal genuine economic weakness rather than a benign normalization. At the same time, there are early signs that pockets of the labor market are softening. A notable rise in the black unemployment rate to 8.4% suggests an increased risk of downward revisions to payrolls and could add political and social pressure for the Fed to ease. Consumer strength is currently anchored by expectations of rate cuts and tax benefits, but that support is conditional on relatively stable labor conditions and layoffs remaining subdued. Fed leadership changes add an additional layer of uncertainty. Market participants are focused on the upcoming Fed leadership transition in May and worry that a new chair perceived as favoring more politically driven easing could introduce volatility and threaten perceptions of central bank independence. However, others argue that a change in Fed leadership in 2026 is unlikely to deliver very aggressive rate cuts on its own, because the chair cannot simply override the broader committee's consensus, which places some limits on how far policy can pivot. A divided Fed, with a majority leaning toward cuts, is likely to create policy uncertainty and confusion, encouraging investors to anticipate lower short-term rates and a steeper 2-year to 10-year Treasury yield curve. The Fed's recent balance sheet expansion, intended to maintain ample reserves rather than stimulate, still adds a supportive liquidity element that benefits risk assets and complicates the inflation outlook, while Bitcoin's price action appears increasingly tied to macro liquidity, government shutdown risks, and the next chair's stance on quantitative easing rather than to incremental regulatory headlines. Safe haven assets are already reacting to the evolving policy mix. Precious metals such as gold, silver, and platinum have rallied sharply to record or near record highs, driven by expectations of easier Fed policy, central bank buying, a weaker dollar, and concerns about potential dollar debasement. Investor preference appears to be shifting toward traditional safe havens over some newer alternatives, with the Fed's expanding balance sheet and ongoing liquidity injections supporting both the rally in gold and broader discussions around de-dollarization. The key risk for markets is that easier policy today sets the stage for harder decisions tomorrow. If rate cuts and continued balance sheet support reignite inflation, the Fed could be forced to reverse course and hike again, posing a direct threat to the current rally in equities and credit. Conversely, if growth weakens more than expected and labor market softening becomes broader, a 3 to 4 cut scenario could emerge, steepening the curve but also signaling a less friendly earnings backdrop. From here, close attention to payroll revisions, core inflation trends, Fed communication around cuts versus liquidity tools, and the behavior of gold and Bitcoin will be critical in gauging how this easing cycle unfolds for multi-asset portfolios. To pull it together, AI remains the dominant market engine, but also the main concentration risk. Growth indicators show a broadening and still resilient expansion, and the Fed faces a narrow path between validating current easing expectations and reigniting inflation or undermining its own credibility. For investors, the next phase will likely hinge on whether AI earnings and productivity catch up with valuations, whether growth stays firm enough to support the earnings forecasts now embedded in equity prices, and how the Fed balances rate cuts with balance sheet policy and leadership changes. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.